Okay, so if you are watching the energy sector right now, I mean really watching it, you are definitely seeing a fundamental shift. It's big
It really is a sea change.
in how power is built, how it's delivered, even how it's contracted across the United States. And look, we're not talking about some slow evolution here.
Yeah, not at all.
This feels more like, well, like an energy gold rush.
A good way to put it.
And it's primarily fueled by this just accelerating hunger from artificial intelligence in data centers.
That's the core driver, absolutely.
So today, yeah, we are opening the books on Vistra Corp's Q3 2025 results.
One of the biggest power players out there.
Exactly. We want to see precisely how they're responding to this structural demand curve shift.
Okay.
We've done a pretty deep dive into the source material here. We're talking detailed earnings reports, covering everything from major M&A activity to, well, massive 20-year contracts.
Yeah, there's a lot in there.
So we're not just analyzing one quarter. We're really looking at the strategic foundation they seem to be pouring for, like, the next decade.
That's absolutely right. And our mission today, it's really synthesis, isn't it? We need to look past just the raw numbers and understand why Vistra's strategic pivot, leaning heavily into reliable gas and their existing nuclear assets, why that's translating into these dramatically different financial forecasts.
Right.
And ultimately, what does this kind of aggressive strategy reveal about the future of power generation, especially across critical U.S. markets like ERCOT down in Texas and the huge PJM region?
Yeah, and just to set the table, the scale of this acceleration is really the key driver.
It's unprecedented.
The source material notes that planned data center facilities across the U.S., they've more than doubled just in the last 12 months.
Doubled? Wow.
And they are heavily targeting Vistra's core markets, PJM and ERCOT.
Makes sense. Where the infrastructure is or can be built.
And get this, in Texas, in ERCOT, the weather-normalized load growth is up 6% year over year.
6%. Weather normalized.
Yeah. Think about that. A 6% jump in electricity demand in 1 year, taking weather out of the equation. Utilities usually, celebrate maybe 1% growth?
If they're lucky, yeah.
Yeah.
6% is it's off the charts. # strategic response to exponential demand.
So, okay, how do you manage that kind of just unprecedented load growth?
That's the billion-dollar question, right?
Well, the CEO laid out 3 main vectors: acquisitions, long-term contracts, and organic development.
A 3-pronged approach.
Let's maybe start with the immediate fix: strategic M&A, buying capacity.
Right, because when demand is accelerating this fast, you simply can't wait years for new plants to get permitted and built. You need megawatts now.
So they bought some.
They did. Vistra successfully closed the acquisition of 7 natural gas-fired assets from Lotus Infrastructure Partners.
Okay.
This immediately added approximately 2.6 gigawatts, that's 2,600 megawatts of capacity to their fleet.
Yeah.
Existing operating assets.
That's a huge immediate bump in capacity.
Right.
But the strategic value, it isn't just the size, is it? It's also about where these plants are located.
Oh, absolutely. It's entirely about diversification and, frankly, risk hedging.
How so?
Well, before this deal, Vistra's generation was pretty heavily concentrated, mainly in ERCOT and PJM.
Okay.
This acquisition, it expands their geographic footprint quite dramatically. It gets them into markets like New England, Iceni, New York, NYSO, and crucially, California, CAISO.
So, spreading the bets.
Exactly. The key takeaway here is, look, if you are stuck just in ERCOT, for example, one really bad regional heat wave or maybe a sudden regulatory shift, that can be catastrophic for your bottom line.
Right.
By operating across these diverse grid operators, these ISOs, Vistra hedges its bets against those kinds of regional market fluctuations. It just makes them a far more resilient company.
And financially, it kicks in right away.
Yep. Expected to contribute about $270 million of adjusted EBITDA starting next year in 2026, which just shows you the kind of financial pressure utilities are under to grab reliable capacity immediately. They'll pay for it.
Okay. So that's the buying part.
Exactly. And sort of paralleling that inorganic growth, they are also pushing hard on organic development, building new stuff, specifically back home in Texas.
What are they building?
They committed to building 2 new natural gas units out in the Permian Basin, West Texas, totaling about 860 megawatts.
Wait a minute, though. Building 2 major gas units, you said targeting early to mid-2028.
That's the plan.
That seems incredibly aggressive, especially given, the current supply chain issues, permitting environment.
It is aggressive, no doubt.
Are we sure this timeline isn't just, management being optimistic? What's the real risk of slippage here?
Look, it's definitely ambitious, But the justification, they argue, is crystal clear. They feel they have to meet two simultaneous massive growth vectors out there.
Which are?
First, the electrification of Texas's expanding oil and gas industry itself. That takes a lot of power.
Right, in the Permian.
And second, that data center demand we keep talking about. It's increasingly settling in West Texas, too, chasing cheap land and power potential.
Okay.
Now, to speed things up, they are heavily leveraging the Texas Energy Fund due diligence process.
State involvement.
Right, which implies, state-level interest in accelerating these kinds of infrastructure projects. The urgency is just paramount. So they seem to be using every lever they can find, including state incentives, to try and hit that 2028 timeline.
Okay, so we see the quick response with flexible gas, both bought and planned.
Mm-hmm.
But gas, it has variable fuel costs, potential regulatory risk down the line.
True. It's not the whole picture.
To really stabilize that long-term outlook, you need serious baseload stability, predictability.
Absolutely. You need an anchor.
And this leads us to what might be the most stunning piece of this whole report. That massive 20-year power purchase agreement, the PPA, signed at their Comanche Peak nuclear power plant.
Yeah, this PPA, it fundamentally rewrites Vistra's risk profile. I mean, fundamentally.
How so?
It commits up to 1,200 megawatts of carbon-free nuclear power. That's a truly utility-scale volume.
It's huge.
To a single large investment-grade customer, likely a data center or similar large user.
And 1,200 megawatts. Just put that in perspective for us.
Well, very roughly, that single deal is equivalent to powering maybe 1 million typical homes, or certainly a significant portion of a mid-sized U.S. city. It's a massive block of power.
And for 20 years, you said?
20 years firm, with options for the customer to extend for potentially another 2 decades, up to 40 years total.
That kind of long-term PPA, is that common for nuclear in the merchant power space? It feels unusual.
It's basically unheard of in recent decades for merchant nuclear. Can you walk us through what a long-term, essentially fixed-price commitment like this really signals to the rest of the market?
Yeah, what's the message here?
Well, it signals a profound shift away from relying on market volatility. That's the core message.
Okay.
So instead of depending on highly variable, a day ahead or real-time electricity prices, which can swing wildly,
Right.
Vistra is replacing a huge chunk of that potential volatility with decades of predictable, contracted cash flow locked in.
And Comanche Peak itself, it's licensed for a long time already.
It was already relicensed by the NRC out into the 2050s, but this PPA provides the solid financial backing to ensure it can keep operating continuously,
Right.
likely through at least the middle of this century, maybe longer.
So it turns the plant.
It basically turns the plant from a market-exposed asset into something much more like a long-duration, bond-like asset.
Predictable returns.
Exactly. And that predictability, that's why the credit rating agencies are watching this so closely. They love that. And there's another interesting piece here, the reliability features.
What about them?
The customer, again, likely a data center, is committed to bringing significant backup generation to the site.
Really, the customer provides backup.
Yep. Which actually enhances overall grid stability in the area. It shows that these massive new customers, they're starting to be seen as part of the resource adequacy solution, not just, the source of the problem.
That's a fascinating dynamic shift. And the value Vistra is getting from nuclear, it doesn't stop with just this PPA, right?
Yeah.
They're looking at upgrades too.
Absolutely. They're still actively evaluating potential nuclear capacity upgrades.
Meaning?
Essentially squeezing more power, maybe 10% more capacity, out of the existing reactors through technology upgrades and efficiency gains, potentially starting in the early 2030s.
So low-cost, incremental, carbon-free power.
Exactly. Low-hanging fruit, relatively speaking. And we absolutely cannot forget the Inflation Reduction Act, the IRA.
Right, the tax credits.
Nuclear Production Tax Credit, the PTC, is generating massive value right now. Vistra recognized $145 million in transferable nuclear PTC revenues just in Q3 2025 alone.
Wow, $145 million in one quarter.
Yep. And that's basically a guaranteed non-market income stream that further stabilizes their financial foundation. It's pure upside from the legislation.
And speaking of licenses, they got Perry extended too.
They did. The Perry nuclear plant license was approved by the NRC. It now extends through 2046, so more long-term certainty there too. Hashtag navigating the transition turbulence.
Okay, it sounds like Vistra's, playing a pretty impressive strategic hand here. Balancing the fast, flexible gas with stable, long-term nuclear.
That seems to be the goal, yeah.
But generating power, especially in this kind of volatile environment with retiring old plants and bringing on new tech, it's inherently risky.
Always.
So we really have to address the significant operational setbacks Vistra faced in the last year or so, because they kind of highlight the turbulence involved in managing a large transitioning fleet like theirs.
That's a crucial point, absolutely. These incidents, they're really direct evidence of the kind of transition volatility Vistra is trying to navigate.
What were the main ones?
The two big ones mentioned were the Moss Landing energy storage facility fire out in California. That was January 2025.
Okay, the battery fire.
And then the Martin Lake coal unit fire in Texas back in November 2024.
Let's look at Moss Landing first. That was a huge battery facility, right? 300 megawatts.
One of the largest at the time. And yeah, that unit was declared a total loss, a major failure in a key emerging technology for grid stability.
What's the financial hit?
Well, the unit itself was written off for its net book value, around $400 million, and they decided they're not bringing it back online.
Wow.
Furthermore, the remediation work, battery removal, site cleanup, that's estimated to cost another $110 million running through the end of 2026.
Ouch.
It really demonstrates the steep financial risk inherent in adopting these new, very large-scale battery technologies. Maybe a painful lesson in, the bleeding edge of tech adoption. Two other battery facilities there also remain offline pending investigations.
Okay, then you have the Martin Lake fire. Totally different technology, old school coal.
Right. An 815 megawatt coal unit, a workhorse in ERCOT. The estimated cash capital expenditures just to restore that unit are around $355 million.
And when will it be back?
They're expecting it back online late 2025 or maybe early 2026.
So these two incidents, one in cutting-edge storage, one in legacy coal.
It really highlights the sheer difficulty, the operational challenge of managing both the retiring, aging fleet and the new, sometimes volatile technologies simultaneously. It's a tough balancing act.
Is there any good news there? Insurance?
Yes, the good news is they seem to have strong insurance coverage. They've filed claims for both incidents, and they state combined business interruption and property loss limits of $500 million net of their deductibles. So that should significantly mitigate the direct financial exposure from these events.
Okay, and despite that coal unit setback, they are still moving ahead with their overall coal transition plan.
Absolutely. Seems like it. They're pushing ahead with projects like the Coleto Creek coal-to-gas conversion, the Miami Fort coal-to-gas conversion.
And the retirement dates are holding.
The definitive retirement dates look set. Key coal units like Baldwin, Coleto Creek, Kincaid, and Newton are all slated to retire by the end of 2027, and Miami Fort follows by mid-2028.
So they seem committed.
Yeah, they appear to be systematically and, frankly, aggressively replacing that retiring coal capacity with, as we discussed, reliable gas and, maybe more importantly for the long run, that long-term contracted nuclear power. Hashtag financial momentum and investor confidence.
All right, so this combination of geographic diversification with Lotus, the huge nuclear contracts, and managing these transition risks, it seems to be showing up very clearly in their forward-looking financial guidance.
Oh, yeah.
Let's look at those numbers, because the jump they're forecasting is pretty staggering.
It truly is, and it really illustrates the market's apparent recognition of this de-risking strategy they're pursuing.
So what are the numbers?
Okay, so first, Vistra narrowed their 2025 adjusted EBITDA guidance slightly to a range of $5.7 billion to $5.9 billion. Pretty solid. But more importantly, they introduced robust guidance for the coming years. For 2026, adjusted EBITDA is projected between $6.8 billion and $7.6 billion.
Whoa, okay, that's a big step up from 25.
Huge step up. And note, they said the midpoint of that 26 range is above their prior internal targets, even excluding the benefits from the Lotus acquisition we just talked about.
Really? So the core business is strengthening significantly, too.
Seems that way. And then for 2027, they introduced an adjusted EBITDA midpoint opportunity range of $7.4 billion to $7.8 billion.
Okay, let me get this straight. We're going from around, say, $5.8 billion in point in 2025 to potentially over $7.5 billion, even $7.6 billion midpoint by 2027.
That's what the guidance suggests. Yeah.
It's almost hard to believe that kind of stability and growth projection in what's historically been a pretty volatile merchant power market. Where's the confidence coming from?
Well, the jump seems to be rooted in basically three key factors we've touched on.
Okay.
One, the full-year impact of the Lotus acquisition kicking in. Two, the continued consistency and performance of their integrated retail electricity business.
Right, the customer side.
And three, The strong performance and, crucially, the highly hedged nature of their generation fleet.
How hedged are they?
They stated their hedge percentage for 2027 generation is already approximately 70%.
70% hedged for 27 already.
Yep. Locking in those margins years in advance provides powerful downside protection against price swings, and that translates directly into the confidence needed to issue these aggressive financial targets.
Okay, so given this confidence, what are they doing with the expected cash flow? Returning it to shareholders.
A lot of it, yes. They're planning a substantial capital return program. They expect to return at least an additional $2.9 billion through a combination of share repurchases and common dividends just through the end of 2027.
$2.9 billion more.
Yeah, and that includes an additional $1.8 billion authorized this quarter just for share repurchases. So they're actively buying back stock now.
Which usually signals management thinks the stock is undervalued.
Typically, yes. And this all leads us to their sort of ultimate financial goal, at least in the medium term, achieving investment-grade credit ratings.
Ah, the holy grail for companies like this.
Pretty much. With their current leverage sitting at a, fairly manageable 2.6 times debt to EBITDA.
Okay.
And this massive influx of predictable, contracted nuclear revenue coming online that stabilizes their business risk profile.
Right.
They believe they are firmly on the path for that credit rating upgrade.
And returning capital while also aiming to deleverage.
It's a very confident move, isn't it? It signals that they view a large portion of that future cash flow as essentially locked in and highly reliable. Hashtag tag outro. So if we boil it all down, for you, the listener, I think the key takeaway here is that Vistra's strategy, it's really a perfect mirror of this new electricity landscape. The one being driven hard by data centers and electrification.
How so?
Well, the core strategy hinges on expanding that reliable gas generation, both through M&A like Lotus and organic builds like in the Permian. That's for flexibility and immediate need.
Go.
Then leveraging their existing nuclear assets for massive long-term contracted revenue, like that Comanche Peak PPA, that's the stability anchor.
Right.
And finally, maximizing the returns from that whole portfolio through smart hedging and significant capital return initiatives. They're basically working hard to convert market volatility into financial predictability.
And that focus you mentioned on large load customers, that feels like the defining characteristic here, doesn't it?
I think so.
The sheer scale of that 1,200 megawatt PPA at Comanche Peak, it suggests that these major energy consumers, like data centers, they're no longer just passive buyers taking whatever price the spot market offers.
No, they're much more active now.
They seem to be active market participants, almost dictating utility-scale, long-term generation capacity planning. That feels like a profound shift in market power. It puts the end user, the data center, the AI cluster, firmly in the driver's seat for influencing future utility development.
A very different dynamic than just a few years ago.
Definitely. And, this leaves us with maybe a provocative thought to chew on.
Okay.
Vistra explicitly said they are actively investing $50 million per year through 2026 just into development activities, hiring people, securing sites, initial engineering, all to, quote, capture these contracting opportunities because the level of customer interest is apparently just that high.
Right, they're staffing up to meet the demand for deals.
So the long-term contracted assets they announced today, like Comanche Peak, have already completely changed their financial trajectory, as we saw in the guidance. Given that aggressive investment in just pursuing more deals, what scale of further long-term contracts beyond the publicly stated financial forecasts we just discussed might already be being negotiated right now behind the scenes? Deals needed to meet this surging, almost insatiable demand from emerging sectors like AI and data centers.
Interesting question. What's already in the pipeline but not announced?
Exactly. The impressive numbers we see today, maybe they're only the foundation for what Vistra might be planning to announce next quarter or next year. The scale could be even bigger than what's visible right now.